you're going to want to watch this one in full before tomorrow. Tomorrow is December 14th. You're going to want to watch this before 11 a.m. because that's when we get a new summary of economic projections. This is going to be very critical for the market. It's going to be much more critical for the market than this 50 basis point idea because we're going to get a new set of projections from all of the members of the Fed, and we're going to see if the Fed is in line with which direction they're going in or if they're scattershot. If they're scattershot, you could have red flags because scattershot Fed members means a lot of contention and anything's game. If they're all game for one direction, we want to know what is that direction and what are they potentially seeing. So folks, let's go ahead and look at the last time we got a summary of economic projections, going all the way back to September 21st of this year. That doesn't sound like it's that long ago, but then again, we had October, November that just vanished, and then maybe like another 3 weeks in between there. That's wild. So it's been 2 months and 3 weeks. All right, so we're gonna go ahead and jump on over to these. The summary of economic projections start with this very specific table. And I want to note something up here first, right after I mention that this video is brought to you by the expiring coupon code tomorrow, PP. We extended it for the programs on building your wealth. Remember the most important ones, in my opinion, real estate investing, 0 to millionaire. Most popular bundle is 0 to millionaire real estate investing and stocks and psych. Stocks and psych gets you into my trading challenge as well, where we're doing volatility trading on options. It's going to be great. At least I hope so. Anyway, that's the expectation. So check out that coupon code link down below. You get all of the buy sell alerts if you're in stocks and psych. 0 to millionaires getting a bunch of new lectures, as well as stocks is getting fundamental analysis lectures coming up later this month. So those will be really cool. And we extended that coupon code to tomorrow evening. All right, so what do we have here? Well, first, it's worth noting, may as well mention that core services and CPI today came in at just 0.1%, excluding energy and rent. This is really good because remember Jerome Powell's third concerning area is services. And so the fact that core services on the good side rotated down like this, really, really good. This comes in after a 0.4 in October, a 0.8 in September, a 0.4, it should be 0.4 before that. We did have a 0 in July though, so this is a number that could be a little volatile. So I wanted to mention that, but so it's good news for now because it's trending down, but it's been 0 before. Okay, so this is what we had last time. This is the summary of economic projections from last time. And I'm going to point out that probably the most important piece out of all of this, I'm going to pick an orange highlighter here. We're going to use orange as our most important highlighter. And that number is going to be right here, down there at the bottom. So it is actually the federal funds rate projection that, there we go, that is going to be extremely important. The reason that's so important is because in June, the last time we got an SEP before September, the Fed was only expecting to raise rates up to about 3.8%. Now we have the market anticipating that rates could go as high as 5%, and there have been murmurings that the Fed might end up stopping at 5.25, maybe 5.5. Some even say, the Fed's going to go to 6%, although those arguments seem less likely now that inflation has kind of tapered, at least in the last 2 reports. So we're probably closer to that 5% number. And the Fed was very clear in November that if they had to redo the summary of economic projections, they would revise up from 4.8. So I'm going to go out here on a limb and make my prediction that if I were at the Federal Reserve, what number I would expect all of these factors to come in at. So I actually think the Fed's going to end up at about 4.8. Now, that's practically going to be 4.75, I believe, but I think that their projection's going to be 4.8. If we get 4.8, it's bullish. That's going to be below what the market is expecting right now, which is about 4.95. If we get 4.9, that's going to be right along expectations. Anything above that, it's going to be a problem. Now, the next number, I actually believe we could see a shift down on. That's because inflation expectations have broken down. We're not seeing this runaway aspect to inflation anymore. We're more worried about policy lags. And I think that could be bullish for markets. To see a downshift here, my projection is 3.7 for the 2024 numbers. So this is 2023 and 2024. So not really getting all the way down in the future, but it wouldn't surprise me to see this potentially move down to 2.6 or maybe even 2.5. So that way they're suggesting that they might think that 2025 might be the get back to the longer term where we want to be, 2.5% Fed funds rate. So That way you have an upward revision here, but you actually have a downward revision here. And that's a way, in my opinion, that the Fed can forecast front loading. I think that would send a very reasonable message to markets. I don't think this would necessarily move markets ridiculously up or down or move financial conditions in either direction. Remember, when markets rally and bond yields fall, those are ways that financial conditions actually loosen, and it's a way that the Federal Reserve can make things a little happier and get people back to spending and manipulate essentially markets. So if you're ever curious if there's market manipulation, the legal market manipulation that occurs every single day is over at the Federal Reserve. And I mean, Congress kind of gave them that authorization. So like it or not, that's what happens. That's the game we play. So another number that I think will be very critical will actually be the expectation for up here change in real GDP. So in the last measure, they actually thought real GDP might drop to as low as 0.2% for the year of 2020. I actually don't know about that. So if you go to the Atlanta Fed Real Now GDP measure, it's a lot higher than that. I'm going to pull that up in just a moment here. Let's see. 5 days ago, they published their last estimate. Okay, we'll look at this together here. So the real GDP from 5 days ago for the Atlanta Fed estimate came in over here above 3% for Q4 2022. We did have a couple negative quarters at the beginning of the year, and sort of mid part of the year, third quarter, we bounced a little higher, especially with the Atlanta Fed's real GDP. We'll see final numbers and all that. But we were positive in Q3. A point is, even though these numbers can get revised, if we have a strong Q4 like this, we might actually see the Fed revise this GDP for 2022 up. That's a sign that maybe the market actually, or the economy's not doing as terribly as potentially expected. So I would think that this might actually move up. I'll use my green color here. This might actually move up closer to 0.5. And they might actually be a little bit more concerned now about the lagging effects of policy and might potentially take the economy here down to a 0.9 or maybe a 1.0 for 2023. And I'm okay with consistency here on the others. That's sort of below trend, under that 2% growth, that's below trend GDP growth. That's what the Fed wants. They think that's going to drive inflation down. It also would not surprise me to see the unemployment rate revised up a little bit for next year, but not by much. I would not expect a big movement here. Maybe you get like a 4.5 or something to that effect. PCE inflation, obviously this number is going to get revised up. We're probably going to be closer to something like a 6% for the end of the year, and it's possible that next year could see something like a 3. I don't think that's going to be very, very meaningful. I think the most meaningful part out of this SEP is really, and I'm going to rank these here in order of priority, I think it's going to be the federal funds rate right here. Absolutely, that terminal rate, this is a game changer. If we get something well into the 5s, it's going to be a big problem, because that means the Fed, even though they're slowing down on their rate hike cycle, is actually suggesting, all right, let's go 25, 25, 25, 25 for a very, very long period of time, rather than pausing in potentially March or May. A March or May pause would put them somewhere probably around 4.5, 4.75, or 5%, depending on when they go to 25, which we think will be pretty soon. We think they might go 50, 25, 25, right? Something like that, which 50 would bring us to 4.25, 25, 25 would bring us to 4.75, just as an example. So that's an expectation. That's a big deal, though. Again, if that's like 5.5 for 2023, markets are going to go to crap. And this is why, to answer the question, a lot of people I answered this also in detail in my course member live stream this morning, because a lot of people were wondering, Kevin, why did the market all of a sudden just go to crap today? I was looking, and really the only explanation was that we're getting a SEP tomorrow. When we get an SEP, trading volumes, like, people sell. Okay, people sell before you get the SEP, and you generally buy after the SEP, because you're going from uncertainty to certainty, right? Generally, people don't like to buy when there's uncertainty, and generally the masses like to buy when they have certainty. This statement is good. You're not going to have another, let's see, schedule Fed 2023. You're not going to have another SEP probably until March. I don't think you're going to have it in the February meeting, but I'm going to find out right now. So the February meeting is the 1st of Feb. Mark your calendar on that. Yeah, the next SEP is not going to be until March 22nd. That's 4 months and a week from now. Really? Jan, Feb, March. No, 3 months. Yeah, 3 months and a week from now. Anyway, that's a long time. That's 100 days basically between now and the next SCP. So for the next quarter, you're trading on this chart. Like, your expectations are based on the new thing coming out tomorrow. It's a big deal. So, like, is it really a surprise that stocks moved down after, in the afternoon today when people realized, crap, we got a SEP coming out tomorrow? No, not a surprise at all. Now, what else is going to be important? Well, I think unity is going to be important. So you'll get range and you'll get central tendencies here. I think unity is very, very important. See here, even though 4.6 was sort of the expectation for, let me zoom in over here. 4.6 was the expectation for 2023. The range was raising rates 3.9 to 4.9%. So that's like the low end and high end. The big concern would be if this range says something, which it probably will, 4.4, I don't think anybody's going to be in the threes anymore, 4.4 all the way to potentially 6%. Like, if you see a 6 handle there, oh boy, that could be dirty, because that person's voice could get louder and louder. So I'd actually say that range is the second most important thing. And I do think there are a lot of clues that could be gleaned from GDP. And then, like, big gap, really, but less so, their projections here on inflation and unemployment. Though, obviously, we're going to look at them. I think, really, what matters to me more is not their hypothesizing on what the unemployment rate or inflation is going to do. What matters more to me is their impression of economic growth and what they're going to do about it, which is the Fed funds rate, right? And then the range of that Fed funds rate. Another way that you could visualize the range of the Fed funds rate is called the dot plot. Dot plot's a really big deal because look at this, okay? This is like really, really interesting, in my opinion. In 2022 and in 2023, look at what you had. Very tight. 2023, very tight, okay? You can see those years right here, 22, 23, right? Look how tight those boxes are. I mean, you're really seeing cohesion around that 4.3 to 4.9 level expectation for 2023, right? Look at how nasty that gets for 2024. They're all over the map. And so I want to see how much cohesion there is for this box right here. That's going to be a critical one. And if we end up getting something like, which I don't think we're going to get, but let's say we end up getting something like, some people over here knocking on the door, basically, that's 5.75. You get something like, come on, iPad. You get something over, I think it's the iPad, not the cables, by the way, or the dongles, because I've tried 3 dongles and 3 different HDMI cables. I think it's the iPad. Come on, Apple, get with it. Anyway, of course, you take it to the Apple store and they'll be like, we cannot re-diagnose the issue, sire. It's like, F it, we'll just deal with the black screen every so often. You know what? It's an opportunity to take a sip of coffee, soak in the information, and think about that pee-pee. The coupon code expiring. Anyway, okay, so, if you got something like this, okay, that right here, that would be hell. That's hell, because that tells you you're going to go 5.25 to nearly 6%. Very, very, that could be terrible. Very, very, very bad. Probably more likely, I would expect more diffusion. So I would guess, so I'll use orange since that's what I've been using for my guesses. For 2023, my guess is probably going to be, we're going to see some folks, some doves over here. What do we got here? We have 6 times 3, we got 18 dots to plot. Okay, so I wouldn't be surprised to see something kind of like this, where you really have that 6, I'm gonna go with 8 dots here, 3 low, then that puts me at about 11, that gives me 7 more dots to plot. I do think I'm gonna get some, I might see a 1 over here. No, not with the last 2 inflation reads. We're probably gonna get more of a 1 over here, maybe 2 over here. That puts me at 14, gives me 4 more dots, and then I'll go 5 1/4 a little heavier, and then 3 over here. That's kind of my assumption of what you're going to see, where you have that sort of central tendency around that 4.8, roughly aligning with what I wrote on the sheet. But I do think you're going to see some bias into that 5 1/4 range. Obviously, if this skews more to the top, it's going to be a little problematic. But that's those are some of the expectations here. So what do you do? Well, I think there are a few things you can do. Number one, this is a very interesting time for tax loss harvesting because you are running up against Q4 earnings, right? So Q4 earnings reports are going to come out third week of January to beginning of February. Then you're going to have a Fed meeting. And if you have bad earnings and then you have fear of the Fed meeting, in my opinion, you could be in a position where you sell now, you buy back in during that fear of earnings and the Fed. That really gives you this week to tax loss harvest. Then you'll also have another CPI report, though, that comes out, I believe it's on the 12th of January. You could Google that one really quick. It's either the 12th or the 14th. It's one of those. And I'm pretty sure it's the 12th. I'll just look really quick. Schedule of releases. That could potentially set off a rally again because that CPI report is going to be like 3 weeks distanced from the Fed. Whereas, see, the reason we sold off on today's rally is because you had the SEP coming out the day after the CPI. So it's like even though CPI was good, you can't really rally. Yeah, it's Jan 12. Okay, sorry, I was right. Yes. Anyway. Yeah, so there is that potential for tax loss harvesting. One of the interesting things that you could do is you could potentially move from single stocks you have losses on to an actively managed ETF. So that way, if that actively managed ETF runs, that active ETF manager can rebalance for you without passing along tax implications to you. Check with your CPA on that. Obviously, it depends on how the ETF manager runs the fund. But yeah, if you have large gains in a stock within an ETF, the ETF manager can trade that. I am an active ETF manager, right? But an ETF manager can trade that for a different set of stocks and potentially not have a taxable event. That's really cool. It's like trading, they call them like units and baskets in the ETF. It's weird, but it's really awesome because it's a way you could rebalance a portfolio without having those taxable gains that you might have in your portfolio where like, this one stock ran so much, but dang it, I don't want to sell it because I don't want to pay taxes at the end of the year, right? Anyway, so that's an interesting strategy right now. Another thing, obviously, staying at a margin, keeping up the cash, working harder, grinding more. It's frustrating, it's hard, but like that's called recession. It just sucks. Nobody's having a great time, and even if you're killing it in some trades, it's so volatile, it's dangerous out there. And that's why I think our trading challenge is going to take a very conservative approach to milking some it's technically active income, but what'll feel like roughly passive income. So we'll see what we can pull off. Anyway, we're excited about that. So check out those links down below on Building Your Wealth. Thank you so much for watching, and folks, we'll see you on the next one.